Financial Forecasting, Chapter 4, Part 2. The cost of goods sold. Costs associated with units sold during the time period. Assumptions for the illustration being shown as FIFO accounting is used. First, allocates the cost of current sales to beginning inventory and then to goods manufactured during the period. The allocation of manufacturing costs and determination of gross profit shown in Table 4-6. So you can see the quantities sold for wheels, casters, and then combined, your sales price for wheels and casters individually, and then your sales revenue combined. Also shows your quantity for your cost of goods sold and the cost per unit, the total cost of goods sold, and then calculates your gross profit from there. The value of ending inventory in Table 4-7 shows that your beginning inventory plus your total production costs, and then subtract your cost of goods sold, giving you your ending inventory of $6,200. Other expense items to keep in mind is the must be subtracted from gross profits to arrive at net profit, earning before taxes. General and administrative expenses and entered expenses are subtracted from gross profit as well. That gives you your after-tax income. Taxes are deducted from the earnings before taxes, and the contributions to retained earnings if you want to roll it back into the company, and also dividends are deducted from the after-tax income. And this actually comes out your actual pro forma income statement that's created from the example we had given. The next thing you'd have to develop is a cash budget. The pro forma income statement must be translated into different cash flows. The long-term pro forma is divided into smaller and more precise time frames set to help anticipate patterns of cash inflows and outflows. Monthly sales pattern. As you can see on here, that gives us our monthly sales patterns that occur from January through June. Cash receipts. In the case of Goldman Corporation, the pro forma income statement is taken for the first half of the year. Sales are divided into monthly projections. A careful analysis of past sales and collection records show 20% of sales is collected in the month and then 80% in the following month. Components costs of manufactured goods shown here. You can see the units produced, cost per unit, total cost, units produced, cost per unit, all the way over to your combined costs on the far right hand side. Cash payments. The monthly costs associated with inventory manufactured during the period, which include material, labor, and overhead as well. Disbursements for general administrative expenses, interest payments for taxes and dividends, and then cash payments for new plant and equipment. Cash payments also go with assumptions for the next two tables that costs are incurred on an equal monthly basis over a 6-month period, and they maintain production level to ensure maximum efficiency, though sales volume varies from month to month. Payment for material once a month after purchases have been made as well. Average monthly manufacturing costs are shown below. And then summary of all monthly cash payments is in this table here. I will provide PowerPoint presentation slides that you can go through as well. But as you can see, this is an example of what we would have as far as all the monthly cash payments would be provided. Actual budgeted monthly cash flows. Difference between monthly receipts and payment is the net cash flow for the month. Allows the firm to anticipate the needs for funding at the end of each month. So you can see total receipts to total payments will give you your net cash flow for each month. So you can see January had a positive net cash flow. February and March show a negative net cash flow. Now those months weren't necessarily unprofitable months, it's just the cash flow during that time frame didn't come in. Same thing with April and May, very well as far as cash flow was concerned, and then June was another poor cash flow month. Cash budget with borrowing and repayment provisions. The assumption is the firm wishes to maintain a minimum cash balance. If the balance goes below the minimum, the firm will borrow. If the balance goes above the minimum, the firm will use the excess to repay different loans that it has available. And this is just an example of what a firm might use for managing its specific cash needs. That will end this video for Chapter 4, Part 2.